Joshua Casey here, coming at you live from Tulsa, Oklahoma. What is going on? If you can hear me, let me know. It looks like we got a couple people up. There we go. Loud and clear. Perfect. Awesome. Well, we're going to go ahead and get started here, everybody. Again, my name is Joshua Casey. I live here in Tulsa, Oklahoma. It is an honor and a privilege to have every single one of you on this webinar, this being my very first one with Disruptive Traders. It is just an honor to be able to coach alongside some of these other coaches, as well as Mr. Steve Greger. So we are going to be going over Waveology and harmonic wave convergence, the basics of it. Today is going to be more so about the history of harmonic wave convergence, how it came about, and how it's been utilized in the indicator fields and what we have now. And then starting next week, and as we gradually progress, we're going to start talking about how we can implement it in our charts, price relationship with INS lines, and how harmonic wave convergence and Waveology systematically helps with our trading process. But before we go ahead and start with that, I'm going to go ahead and make sure this is working here. My first time using GoToWebinar, all right? So once I go check, well, I'm going to go ahead and check this, guys, real quick. If you can, go ahead and tell me where you all are from. Tulsa, Austin, Orlando, Oregon. Okay. Belgium. Wow. Austria, Berlin. We got people from all over the world hopping. What time is it over in Berlin? Jeez. France, Trinidad. Wow. Okay, that's not too bad. 2200. Okay. Gonna resume that. Well, I thought I had everything in order here, and I'm trying to get my ink to go to pop up. You're right, Clay. It could be on the wrong screen here. No, it's right there. It's hidden. Oh. Sorry, guys. Like I said, it's my first time using GoToWebinar here. All right, here we go. We're going to go ahead and get started. So first and foremost, we have to get started with our disclaimer for those of you who have been on some of the Disruptive Traders sessions. We have to go through this disclaimer, so I'm going to read through it thoroughly and as quick as possible for all of you. So, risk warning and trading disclaimer. Trading foreign exchange and margin carries a high level of risk and may not be suitable for all investors or traders. There are no guarantees of profits, and most Forex traders lose money trading. Hold on, I was just making sure I was recording. Past performance is not indicative of future results. The high degree of leverage can work against you as well as for you. Before deciding to invest in foreign exchange, you should carefully consider your investment objectives, level of experience, and risk of appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should only invest money that you can afford to lose. You should be aware of all the risks associated with foreign exchange trading and seek advice from an independent financial advisor if you have any doubts or uncertainties. This presentation and all of its contents, including past trades, potential trade setups for educational and informational purposes only. Using any strategies, techniques, or software mentioned in this presentation is also very risky. We make no guarantees of profits of any kind. The presenter is not a licensed financial professional and therefore will not give any financial advice or recommendations. All information in this presentation is our opinion and may not reflect the truth or reality in the world of trading. Please use your own good judgment and seek advice from a qualified consultant before believing, accepting, and acting upon any information in this presentation. This is not a solicitation to invest. Wow, that was a lot. Okay. So that is the trading disclaimer. We have to read that and make sure everybody understands that we have this disclaimer here. We will also reiterate that at the end of our presentation. So just so you all can get to know who okay. Sorry guys, I gotta read the other half too. Here we go. Hypothetical performance results have many inherent limitations, some of which are described below. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. In fact, there are frequently sharp differences between hypothetical performance results and the actual results subsequently achieved by any particular trading program. One of the limitations of hypothetical performance results is that they are generally prepared with the benefit of hindsight. In addition, hypothetical trading does not involve financial risk, and no hypothetical trading record can completely account for the impact of financial risk in actual trading. For example, the ability to withstand losses or to adhere to a particular trading program in spite of trading losses are material points which can also adversely affect actual implementation of any specific trading program, which cannot be fully accounted for in the preparation of hypothetical performance results, and all of which can adversely affect actual trading results. Reward and disclaimer: your actual commissions and residual income will vary dependent on your work ethic, hours you spend on customer acquisition, and the quality of customers you refer. All right, geez, that is a mouthful, guys. I hope you all got that. Take a screenshot. There you go. So that is our disclaimer. I want to go ahead and move on to who I am. Just a quick introduction of Josh Casey, so you know I'm a real person on the other end over here in Oklahoma. Let me get this back up. Resume slideshow. There we go. And here's me. Some of my friends, most of my family, top right-hand corner. I am a United States Marine. You know the term, once a Marine, always a Marine. I got out of my active duty status in 2011. Those are mortar pits behind me. So I was what they call a indirect fire weapons specialist, and I was a FDC chief. So that's a fire direction center chief. So I joined the Marine Corps, went into the infantry as a grunt. That's what they call us. And then they found out I knew math. So they sent me through infantry mortar leaders course. And I was the guy who calculated all the different angles and trajectories of basically where the mortars went or where we shot them. And that is my mother right there in the middle with me. When I got back home from, yeah, they found out I was a smart gun, right? So that's my mother right there. She was the first person I saw when I got off the bus back from Afghanistan over there in Camp Lejeune, North Carolina. That is my beautiful wife right there on the right-hand corner. Right next to me, we were at a charity event there. And then bottom left-hand corner, you can see me with some of my network marketing friends. And yes, that is Dallas Greger in the back there. He was over at ANMP, the Association for Network Marketing Professionals. It was an awesome place. If anybody's in the network marketing industry, highly, highly recommend checking that out. And then middle picture just shows I'm talking in front of a group of people. I did a lot of public speaking, did a lot for network marketing as well. And last but not least, that is my beautiful daughter on the bottom right-hand corner. 6 years old, little ball of fire. Just learned how to can swim on her own. We just got back from a camping trip 2 days ago, so just love seeing that little one grow up. So that's a little bit about myself. Again, live in Tulsa, Oklahoma. I am a marketing director for a roofing company. I, of course, trade Forex. My wife has her own coaching business. And then I'm a sales representative, they call me the VP of their company for a hormone clinic. But got a lot. So that tells you guys, excuses don't pay your bills, right? So moving right into it, guys. Like I mentioned before, this session is just more so an introduction of who I am, what we're going to be going throughout the next few weeks, the history of harmonic wave convergence, and then moving forward, how we can implement harmonic wave convergence in our trading strategies and ideas. So Disruptive Traders TV works with you with your psychological growth. That is 100% true in my personal opinion. Old paradigm thinking versus the new paradigm, or what we consider this new paradigm shift in trading. So old paradigm thinking, 75% win ratio equals 25% losers. You have to stay in the trade or you're going to through being stopped out. That's an old paradigm way of thinking on how to trade. And when it comes to trading with Fast 33 or Tab 29, with what we use here in Disruptive Traders TV, That is the paradigm shift, because now we're flopping that over to 75% win ratio, which equals 10% losers, and then 50%, 15% what we call break even plus ones or slushes. You gain a pip, you lose a pip, you're out of the trade. So high yield, low risk. It's no longer about your win to loss ratio, because when it comes to learning the strategies that these coaches are teaching you here at Disruptive Traders TV with Waveology, pitchforks, the clayway, all this, you can lose 5 trades and then still, be pit positive with the one trade that went in your direction based off of the different strategies that you learned. And let's see here what I missed here. So you have the tools to take you out early. It's the psychological growth that you're going to be going through and understanding how to trade when it comes to using these tools. You learn you can swing and miss and it not count against you. And we're going to basically teach you how to do that. The new Disruptive Traders goal, see how many trades you can get in. I got 3T squared. That means take the trade, take the trade, take the trade. Don't worry about winning versus losing. That's not the point here. So what we're trying to teach everybody here is, one, we have almost 19,000, we have close to 19,000 people in the Scan, Forks, and Fibos group. And, we see a lot of people putting posts in, but we know that's not merely enough for people to have, one, that psychological growth, and then two, learning to fail so that you can succeed later. So, it comes down to, hey, if you want to learn how to trade, have an understanding of Waveology, learn how to trade these different strategies and systems. We all heard the term knowledge is power, but I don't believe that. It's applied knowledge that's power. So we want everybody to start applying themselves. We want everybody to start taking demo trades and posting them. That way, if you did fail or if you did lose a trade and you posted it, that's when one of these coaches can come along and say, hey, this is what you did wrong, and here's how we can fix that. So that's why it's so important to start posting some of your trades, implementing these strategies, and figure out what it is you did wrong. That way, you know what not to do later on down the road. So moving forward, what is harmonic wave convergence? It's the occurrence of 2 or more levels of cyclical waves, harmonic, exhausting or terminating at precisely the same time and price. When this convergence takes place, price will almost always reverse. So I have 2 examples that I wanted to show you guys here, that I'm showing you guys here. One is I wrote down as old school. You guys will no longer see this. For those of you who knows what it is, we're not implementing it, but this is what tab 29 and fast 33 basically evolved from. This is what we call multi-wave. It was what we called it purple into the blue, when we had 2 waves cycling to at static extremes that you see here where the arrow is pointing, and at that point you'll typically see a reversal of price, and you'll see that price action, and you can actually see the 62 EMA where price is interacting with, and that was just one of our entry criterias. Later on down the road, Steve and his team developed tab 29, and now you see tab 29 or fast 33. In this example, you see tab 29, where it's just a way more precision tool. I know it seems a little convoluted, but it's not, because you guys at the end of the day are going to be pattern recognition experts. You're going to understand what this is and how harmonic wave convergence, is one of, in my opinion, one of the best confirmation tools out there. So how much do we have to know in order to trade? This is a quote from Mr. Steve Greger. That's right, he does. Sometimes the hardest part in teaching a trader a new concept is to successfully communicate the transitions or differentiations points and what they need to learn in order to trade, as distinguished from what they need to accept in order to trade. This is particularly true for analytical type A personalities, who have a driving compulsion to understand the how behind everything. And yes, you know who you are. I'm that guy. I was that guy. I was the person that wanted to go through every single video 12 different times. That way I had a massive understanding about what it was that I was looking at. Just to kind of give you guys an example, traders accept the representation of a candlestick and the price associated with the open, high, low, close shown on that candlestick, without having to see the raw data feed. How the programming code praises out the pieces of the data feed which represent the open, high, low, close, and the graphic routines and actual code which draw the candle and scale it based on the program's praised data. They merely see the candle and accept everything behind the scenes. They accept it completely, enough to put money on the line, merely on how that candle appears on their trading charts. The reality is, many of these analytical traders did want to know how all that worked up front. However, over time, they accepted what the candlestick represented without having to learn how the candlestick works. As they experienced that knowledge was not necessary to successfully trade, they could merely take what the candle looked like and make trading decisions, trusting that representation and what it stood for as they saw a candle forming or as they look back on history of pricing. So that goes back to what I was mentioning earlier to you guys. It doesn't have to be too convoluted. You don't have to know, the specific coding of how a broker works or why that candle formation is the way it is or how long that candlestick is or the actual calibrations or coding behind everything on the charts. It's developing your reticular activating system, your RAS, to understand a system that's been provided to you so that you can successfully trade. There we go. Sorry about that. So going more into the history, so what I'm going to do for you guys, I'm just going to kind of go over the history of how harmonic price movement works, or how the history of it started, and then we'll try to get into some charts as well. So a young stockbroker, W.D. Gahn, already suspected that there were unseen causes operating behind the scenes that were responsible for price movements in stocks and commodities. He liked to think that these hidden causes were part of a natural law that was secretly at work in the markets. As he acquired more knowledge and developed his theories, Gahn systemized his theory of price movement and called it the law of vibration. In the Ticker magazine interview, Gahn states, in going over the history of markets and the great mass of related statistics, it soon became apparent that certain laws govern the changes and vibrations in the value of stocks, and there exists a periodic or cyclical law of which is at the back of all these movements. I soon began to note the periodical reoccurrence of the rise and fall of stocks and commodities. This led me to conclude the natural law was the basis of market movements. Gahn states, after exhaustive research and investigations of the known sciences, I discovered that the law of vibration enabled me to accurately determine the exact points to which the stocks or commodities should rise and fall within a given time. The working out of this law determines the cause and predicts the effects long before the street is aware of it either. Ooh. Gahn concluded by stating, if we wish to avert failure in speculations, we must deal with causes. Everything in existence is based on exact proportion and perfect relationship. There is no chance in nature because mathematical principles of the highest order lie at the foundations of all things. Moving forward. Gahn's law of vibration incorporates Pythagorean's law of harmonic intervals. It is obvious that Gahn drew heavily from Pythagorean mathematics when he developed the squaring of price and time and the ratios by which highs and lows could be divided. A lesser known part of the Pythagorean system included numbers ruling planets and the ratios of their orbits, which are in harmonic relationship to each other. This harmonic organization of the cosmos was called music of the spheres. While it is well known that Gahn's primary market timing tool was based upon cosmic correlations, what is not understood by most Gahn adherents is that Gahn's astro work was based upon empirical research, irrespective to traditional astrological doctrines. Gahn makes this clear when he states these vibratory forces can only be known by the movements they generate on the stocks and their values in the market. In other words, to obtain a high degree of accuracy when applying natural cycles, one must learn through empirical research which cosmic cycles and events correlate historically with particular stocks, indexes, or commodities. This can only be ascertained by doing original research to discover the historical correlations. For example, the October 19, 1987 crash low was perfectly timed by the 84-year Uranus cycle. Uranus reached the exact same position in the heavens where it was on November the 9th, 1903, the day of the 1903 crash low, The 1987 crash was preceded by the August harmonic convergence, a rare planetary alignment which was widely advertised in the mass media. Our March 1987 forecast for a major top to occur at the new moon on August 24th and to be followed by a 3-month correction perfectly timed the 1987 stock market top within 1 day. And so that's a woo-woo right there, right? That is just absolutely mind-blowing. That what you guys look at on the charts as far as your visualization goes in that indicator field originated from this variable. Absolutely cool. It's amazing. Right. I mean, yeah, right. Go to Colorado for that, Joe. So this is how it all came about, guys. With some science and history background behind us, let's now zoom into current day. So a wave, in its simplest term, a wave is a simple symmetrical oscillation or fluctuation that moves from peak to through and back indefinitely. Just one interval of this wave from top to bottom, back to the top again, is called a cycle. All freely traded markets are made up of these price waves. That is the common element of all markets. It is theorized that all price movements of all stocks and commodities consist of the same type of number of these price waves, providing a degree of predictability of when the market is going to reverse. Once you have come to understand these price waves, you will gain a better understanding of how they produce the results, peaks, and throws. Because these price waves repeat indefinitely, cycle after cycle, once you have identified the wave's patterns itself, you can determine its value at any point in the past or future. This characteristic of price waves is what gives it a degree of predictability. So that's why I'm going to reiterate again. That's why, when it comes to disruptive traders and some of the people that utilize these, harmonic patterns and harmonic price movement tools, we are considered pattern recognition experts. Harmonic. So the definition of harmonic, for all its intents and purposes, harmonic really translates to cyclical. In terms of price, we mean predictable tops and bottoms based on a time period and a specific price channel. Convergence is the approach towards a definitive value, definite point, a common view or an opinion, or towards a fixed or equilibrium state. In mathematics, it describes limiting behavior, particularly of an infinite sequence or series. And then here we have harmonic wave convergence. The occurrence of two or more levels of cyclical, hence harmonic, waves exhausting or terminating at precisely the same time and price. The precise time and price thus represents a convergence point for the various price waves. When this occurs, price for the upper level wave being studied will almost always change direction. So that is how harmonic wave convergence came about. So pretty cool stuff. I'm just the kind of person that just gets fascinated when I look into this information. It's just mind-blowing. The 16 plus years that Steve and his team of traders came about, researching and coding and, just calibrating all this to get onto TradingView, just still to this day blows my mind. So now don't get this confused with harmonic patterns. So don't confuse harmonic wave convergence with harmonic patterns. Harmonic wave convergence measures the strength, the exhaustion point, and convergence of multiple level waves, and is presented as a study with multiple plots using I put in here the tab 29 or fast 33 indicator and an indicator channel on the charts, as you guys can see here on the bottom. So what I'm showing you guys here is what we call a 10-minute harmonic wave convergence. I'm not going to get too in-depth with it, but we will down the road, possibly next week. But that middle blue line that you see there is what we call the 30-minute wave, and it is in a neutral point. And this is what we call a 10-minute convergence. And then price shifted, I believe it was close to a 9-pip move there. That was just a screenshot from one of my demo posts. And then, of course, we have harmonic chart patterns. There are visual candle formations on one time period chart first discovered by H.M. Gartley in 1922. So that sounds very familiar, huh? I believe that is a Gartley pattern there too that I got from harmonicpattern.com. So two complete differences between harmonic price movement and harmonic chart patterns. But now, as disruptive traders, we can actually use the two to help complement one another as confirmation tools in order to trade on our charts, which is awesome. I know most of us have, I believe it's harmonicpattern.com as one of our tools that we use to draw harmonic patterns. Lastly here, before we get on to some examples, I want to show you guys, make sure I got this for you. So again, what is harmonic wave convergence? So as traders, we realized over time that our psychology, our wins, our losses, our understanding what's really happening on the charts was really the biggest element of becoming a successful trader. Through nothing more than pure luck in some of our research, we stumbled into some simple realities that were consistently all in price movements. Since harmonic seemed to fit the bill, we stuck with what concept to refer to consistent patterns, fractal, scalable, which repeat themselves over and over again. We also noted that most pro-trend, the trend is your friend, right? Trading use profit gobbling, large stop losses, and that one only had to look at the charts and see what there was as a directional change in price. That one could get in fairly tight with their stop losses. This meant that there would be two great benefits: a smaller stop and significantly more profit per pip in wins by magnitudes. And that's what I was discussing to you guys earlier on that first slide. We also noted that no one had an indicator that could tell us much about pinpointing these consistent moves and their precise turnarounds. Unrelated, but pursued at the same time, was an attempt to further our knowledge in the understanding of Elliott wave theory. While we found it hard to be consistent wave counters without a lifetime of devotion to it, we did understand some basic principles. The first is that Elliottians use Fibonacci-based projections to predict potential endpoints of their waves. Since we already realized everything on the charts was all about Fibonacci, this led us to believe that while we could not particularly apply Elliott wave, that we were interested in the theory at the conceptual level, because Elliott wave does not indeed cover the repetitive patterns that reoccur over and over again on all time periods. What we learned is simple Elliott wave 101 stuff, that when projecting the next wave, there were precise formulas, but the Elliotticians would always drop to a lower level to do the projecting. And this, while not profound at all, is the key to understanding what is happening with price on the charts. And that is quite simply that in order for an upper level wave to terminate, there has to be a lower level wave, and that upper level wave that terminates first. And since Fibonacci projections are used to project out the termination points, the deeper the Elliottician drives down in levels, the more precise they can have in determining where those lower level waves will end. And hence the next level and the next level and so on. The challenge was maintaining the real-time count on many levels of waves and then being able to sync up so one could simultaneously see the real-time relationship between the lower level waves and the upper level waves. All right, real quick guys, I know that sounds a bit profound. It's a lot of convoluted information right there, and we're not trying to teach you guys to be master Elliotticians. If that's something you want to do, good luck. That's going to probably run you maybe 1 to 2, maybe even 3 years. If you have a basic understanding of Elliott wave, awesome. If you don't even know what the heck Elliott wave is, don't even worry about it, because we're not wave projectors. We are pattern recognition experts when it comes to using these strategies that you guys are going to implement and learn. So that is basically the history of harmonic wave convergence and what Steve and his team of traders have helped develop throughout the next couple of years, and what you guys see on the charts, what you guys see a lot of people posting as far as their demo trades and whatnot go within the group. So real quick, I wanted to see if anybody had any questions in regards to what I just went over before we go ahead and move forward. Yeah, a lot of information there, guys. I know, but it's just, to me, it's one of those things that's just so fascinating that, I like to get a little bit of a history lesson, but that way I have a general understanding of what it is that I'm looking at. So now you guys know what, in a sense, where harmonic wave convergence comes from, or what harmonic price movement is. That made me feel a little more comfortable moving forward with what it was I was looking at within this indicator field. So, now I know some people have Fast 33. I know some people have Tab 29. I know some people are interested in looking at what it is. I personally believe it's one of the best, confirmation tools out there. But just wanted to show you guys a live chart and just kind of go over what we can find here. We don't necessarily go back into the past to figure out, where some of these convergences are, because of the calibration points. Some of the waves actually end up changing. Let's see here. Get back here real quick. Any questions? Okay. So before I get into this chart, I will go ahead and I'll go to a blank screen real quick here. I got 5 screens. I'm jumbling everything up over here. Let's see, where's that? There we go. Okay. So how this basically looks within our indicator field when it comes to harmonic wave convergence is, here is our indicator field at the bottom of our charts. And I'm going to kind of just relate everything more so towards what our tab 29 system that we have. This right here will represent what we call your peak 30, and you will definitely understand. I will tell everybody what everything means. That's going to be coming along the road. This is your peak 30, or your 30-minute wave. This is what we call your power 10. Now your power 10, one second here, guys. And then this is your 1-minute wave. Once I can find it here. So at this point, just to give you guys an example how this works within the indicator field, in relation to price movement, when we're looking at, let's say, like I mentioned earlier, a 10-minute harmonic wave convergence, that's when your power 10 goes within the static lower extreme, and then your 1-minute wave follows in shortly after, while your larger 30-minute wave is within a neutral zone, or we call it, or say it's not an influence. Let me go ahead. I'll just use blue here as price. So as price moves down, probably the worst representation of what we have here. But just to give you guys an example of what this is, typically when you have price meet at a turnaround point, or when you get that convergence, for let's just say this is that 10-minute harmonic wave convergence, that's when you get that reversal right there. So what we do is when we utilize, that's why it's such a good confirmation tool, we'll also have our trend bars that you saw in the example previously. When you have a 10-minute or a 30-minute convergence, typically your execution is you'll have a trend bar flip to help give you confirmation to say, hey, green means go, red means also go. You're waiting for solid bar flips, or if you guys are using Fast 33 as well. But that's just how the Waveology basically works in relation to how you get a visual aspect and looking at it. And to give you a live chart example, I tried to find the example I couldn't there. Is this Euro USD? Better on you. Oh, here we go. It's on the other chart. Now, as of now, the markets aren't going to be doing much, especially since market turnover is going to hit in about 30 minutes. And that's not a good representation, right about here. Now, it would be a lot better if this 30-minute wave that you guys see here, this peak 30, was in the what we call the power zone, or this neutral area. But this is somewhat a representation of what a 10-minute harmonic wave convergence would be. However, if you end up seeing this this peak 1 snaking along the upper static extreme that we see here, that typically sometimes means that the price channel will continue to a higher high in this case. But it didn't. It did reverse, and then you see the trend bars, they flipped red. But everything that I basically mentioned to you about harmonic wave convergence and its relation to what you guys are looking at right now in visual order. Let's see here. Okay, so some of you guys only have fast 33. So the difference between what you're looking at right now and fast 33 is that blue line would go away, and then of course the power 10 would go away, and then you guys have that peak 15. So what you guys are basically trading when it comes to fast 33 is 15-minute harmonic wave convergence versus what I'm trying to show here, which is 10-minute harmonic wave convergences. So that is what in a sense you're limited to, but you still have a lot of the other confirmation tools to help you guys with your trading strategies. In my personal opinion, you just have the other waves to help you with your strategy, especially when it comes to your clayway trades. You know, I have some of my charts. I had my fast 33 here in the middle because that 5-minute band, or excuse me, that 5 peak. That peak 5 right there was the only one that mattered when it was interacting with that Bollinger Band. But that's a little more advanced. But that is the difference, is that you're limited to 15-minute harmonic wave convergences when it comes to fast 33. Let's see here, another example. But we will get into some, it's still considered basics, but we'll still get into the basics of how these waves cycle through, and it's not so much Elliott waves, but how we'll be able to basically trap these trades, price interaction with INS lines. You guys have access to those INS lines, and how they relate to the different types of 10-minute harmonic wave convergences, the 30-minute harmonic wave convergences, and when price basically turns around once it interacts with a specific line. Right here, all I have is a shadow band 5. Don't know why I have that only on there, but I have my INS lines turned off. So these change, but the majority of the time when you have a harmonic wave convergence, you'll see price interacting with an INS line, intraday navigational support line, or a shadow band as well. But we'll get in depth with that on the next couple of sessions. Again, this was more so just a history lesson and an introduction of what we're going to be going over. Let me look at the questions. I know there was a few questions that popped up. Okay. So tab 29 stands for tops and bottoms, and it has 29 different indicators within that indicator field. So you can see on the lines here that each line from this trend bar has each one has basically an indicator within that field. The power 10 is considered the most powerful line or wave, excuse me, in this sense, because it has, correct me if I'm wrong, I believe it has the peak 1. It has a 3-minute wave. It has a multitude of more waves within that one wave itself, which makes it way more accurate. That's why the power 10 is so powerful. And And then that's why when you have the power 10 go to a static extreme or even a rolling extreme, which you will learn from the clayway, once you move from beginners to intermediate advanced, that's why that wave alone there is just so powerful. But again, we actually use the peak 5 when it comes to using the clayway trades, which you have access to with Fast 33. But it's just a condensed version of what used to be what we had was multi-wave, where we had just so many of these different waves just jumbled up on one chart, and now it got condensed into tab 29, where one wave actually had a multitude of different waves within just that one, which is why it's called the power 10, because it has more waves within just that one indicator alone. But that's why it's just more of a powerful tool. That's why we always emphasize, hey, tab 29 is definitely the way to go. But again, Fast 33 is just another version of that. Yes, tab 29 can be used. Multi-wave, I'm sorry, tab 29 and Fast 33 can be used on higher time frames, but I believe Fast 33 is limited. We always like to stay, I'm practice what you preach, and I only practice on a 30-minute chart and below. I do look at higher time frames just to look at the higher level waves that you guys can see here. This was actually that harmonic pattern that you guys saw in my presentation earlier. So I look at the higher level waves in relation to the 30-minute wave to see where the larger swings are going to move. But I'm the kind of person that uses I literally just trade within a 30-minute chart and below. But yes, you can use tab 29 on a higher time frame. Yes. And it can be used more of a swing style, but that I haven't, like I said, I haven't really got into that part. I know that there are a few other tab 29 traders that use daily swings, 480 charts, 240 charts for their trading by using tab 29, but I keep it with the 30-minute chart and below. But there's nothing saying that you can't try it out. But we always emphasize trying on the lower time frames as well, especially if you're trying to, Brian, if you're trying to fit within a specific schedule, that completely makes sense. But we'll also go into setting up alerts to help you get to the chart, so you're not just sitting there waiting for something to happen. So that could be a little more flexible within your time. Let me see what other questions I might have missed here for you guys. Unclear. Okay. So again, guys, this was just an introduction. Oh, here we go. Could this be used during 7 p.m.? Yes, it can be used on later sessions. It could be used in the evening times as well. There's no specific time of day that this cannot be used at. We typically like to emphasize trying to do you stick with New York or the Euro sessions, but you'll see a lot of what we call eastbound movement where price just doesn't move at all. Typically during the times between, I would say, 10 a.m. all the way up to about 8 p.m. Central time. I'm central over here. Yeah. So other than that, guys, that was just a simple introduction into, Waveology. Tab 29, how Waveology corresponds onto the charts by using tab 29. A little bit of a history lesson about it, and then we'll start going into more live examples and how we can use tab 29 and its relation to price interaction, its reversals when it interacts with a specific INS line or a shadow band. We'll get more in depth with that with more live examples as well on the next session. So just wanted to basically give you guys a little history lesson there, because you got to know the path so you know where you guys are going. You know, it's not all about just lines and figuring out when to get into a specific trade. It's more than that. But for those of you who just started trading, for those of you who just got involved with, you know, Fast 33 and Tab 29, or you just got on board with Disruptive Traders TV, uh, you know, you guys just made the first step to, you know, becoming a successful trader, and that's by showing up. You got to show up to go up, and at the end of the day, you guys showed up, and I'm very appreciative of that, and I appreciate you guys for hopping on and doing that. So, you know, it really comes down to the head game. It comes down to posting 100 different 100 demo trades within the groups so that you guys can continue to learn what not to do, and that's what it really comes down to. So, you know, I've known Clay, I've known Tim for quite some time, and these guys have Josh Grellner and all the other coaches, Zoe, they have posted literally 300 plus trades before they even decided to move to the next phase of their trading, and that's just absolutely nuts. You know, I put in a couple hundred trades, but that's what it takes. You guys have to be able to put, if you're into pitchforks, keep posting your pitchforks, keep taking these trades, keep taking your demo trades, and if you're gonna fall flat on your face, that's totally fine, because what sets you aside, or what makes you different than everybody else out there in the world, when socioeconomics kicks in, we can get at it later, it that's what makes you a successful trader, because you continue to get up and you continue to keep moving and you continue to learn what not to do. So it's all about that repetition. So you know, I'm really excited about what's going to be, you know, coming forward, what we're going to be teaching next week. I hope you guys are going to be able to hop on there, because we'll actually be going through some, like I said, live examples of harmonic wave convergence and waveology. So with that being said, I always like to tell everybody, money comes and goes, but the one thing you'll never get back is time. Your time is valuable, your time is precious, so use that valuable time to spend with your loved ones. I know that trading is going to be a gateway for most of you to get that time freedom. So love you all for hopping on. I appreciate it. Really excited for what I have planned out for you guys next week. Again, it's going to be some more chart time than anything, and it's going to be exciting, because we're going to start implementing, you know, Waveology and its interaction with these different indicators that we've already been given, and then we're going to start posting these trades, and then we're going to start, you know, we're gonna kick in a high gear. So I appreciate it, guys. Thank you all for hopping on. And last but not least, I gotta throw out the disclaimer for you. Let me get that in. Always gotta end the session with a disclaimer. So let's see here. There we go. I don't know why it does this part on my slideshow every single time. Trading disclaimer. Boom. So thank you all for your time. Again, I appreciate you all hopping on here. Like I said, stay tuned for next week. Really excited. We got a lot of good information coming about for Waveology and the basics of harmonic wave convergence. So really excited for that. And I will see you guys next week. And the recording will be posted. It's within the files, so you can actually go into the file section within the Scans, Forks, and Fibos Waveology group, and it will be posted there by Zoe sometime this week. So for every session, I believe she posts them the next day or the day after.